All right, so good day. It is, what day is it? 6/7/2017. I hope everyone had a great day so far trading. We actually went to the zoo, so there was a lot of good things there that we saw. Bears and flamingos and all kinds of things. And sometimes with trading, that's one of the great things about trading is that it allows you to have that luxury of free time and have that space where you just get to go out, enjoy your life a little bit, come back, and things still have not changed, and you've made a little bit of money. So looking at some of these questions, what I'm going to do is I'm going to rifle through and try and answer these questions in as much detail as possible. The lesson today that I had planned and scheduled is really all about looking at profits and taking profits and how to deal with profits and profit taking, simply because I realize I haven't covered that in as much detail in the past. And I think it's one of the important key points to really look at when it comes to trading. Because in the end, it all comes down to understanding and learning and looking at your profit potential. So I'm going to go ahead and do this all on a screencast since I don't have my drawing programs up. So bear with me on this. It will take me probably a little bit more time than usual since doing a live session. So when we look at all these questions, let's take a quick peek and let's just go through them. So I'm going to start actually from the bottom. How do you deal with losses? Dealing with losses, it's a difficult question to answer. I think we'll tie that in with doing the profits. What do you think about Tesla? Could you tell us what you think if you can get to it, please? Absolutely. So let's start looking at some stocks here. Looking at Tesla here, and let's go to the screen. Let me get rid of some of these other things. There you go. Should see the screen right now. Okay, wonderful. All right, so when we look at Tesla, this stock is a power stock. It's a monster. When you look at this stock and you're looking at an ABCD pattern, if you're familiar with ABCD patterns, technically this is your A point, then you have your B point over here, your C point over here, and the D is actually up there. Now you do have smaller ABCD patterns integrated in that movement right there. And this stock, according to its price projection, if you look at it, 260 points roughly, if you want to do the calculations, you can, is what it did. And now when we have this B to C that just happened, and now the explosion of C to D, you could go up about 260 points. Okay, so 260 points on this one from this price level should take it to about 440 on a price projection level. Now, keep in mind, stocks can get stretched. You can get 450, you can get 480, you can go even higher. Not saying it's going to get there, okay, but that's kind of the ABCD projection. Would I get into this one right now? No. We've talked about this one in the critical charts in the past, about this breakout point here, and then some of the digestions that have been happening in the support levels right there. I wouldn't chase this one. I'd look for pullbacks. It had another clearing level there with good volume. You can see the volume there. It's crystal clear to go into this one. But I don't chase these kinds of stocks. If anything, you could sell puts against it to get in at lower levels, and then you get the stock assigned. Maybe that's the better approach to play it, but I wouldn't start chasing it up here. Or the other approach is to get in it like a little bit at a time, 50 shares, then another 50, and now you have your 100 shares position if that's what you wanted, or 50 shares times 4 times, and you get your 200 share position, depending on how large you want to go. Okay, how do I scan for gappers? Gap ups in the TC 2000 platform, which is what I'm using right now, and you get a discount, by the way, if you go through the Traders Fly website. I don't believe there's a way to scan for gap ups unless you can change the column. I don't personally just scan for the gap ups or anything like that. Normally what I would do is look right away at the daily change right here, and you can sort it by the daily change. So right above my head, there's a percent change. You could do a net change, you could do percent change, and here I have Russell $11 and higher, and also 85% in volume. Now, if you want to do just the S&P 500, you could do that. And again, the same thing. So take, for example, right here, this SIG, and you'll be able to see that right there. ICE, the same thing. How is it moving? How is it going? This is kind of like the top 10 gainers, top 10 losers. The same thing with the gap downs. You could do the same kind of thing. If you look at the Thinkorswim platform, if you have that platform, probably I should also use the Interactive Brokers and TradeKing for you guys. But they do have if you go into it, and I don't really change it too much, but if you go to the top 10 right here, losers and gainers, NYSE, and you could create some other things in here on the watch list, analyst upgrades, downgrades. So there's different ways right there to do it. Top 10 net gain, net loss. So you could look at it this way. I don't usually look at a gap up specifically in the software. Usually it would be just the percent change. And if you look at the percent change, there's only going to be a handful of stocks, let's say on the S&P 500 right away. Boom, you'll see, and you'll just go through it and see which ones are gapping up. Like, for example, this one, as you can see, gapped up because right there kind of was closing at a lower price. There was the open, and obviously there was the close. So it gapped up on the open. So that's how you kind of do it. And within a couple minutes, you can see I can look through these stocks. So that's how I would look at gappers or gap ups. What are your suggestions after huge losses in trading? All saving if during trading it wasn't always bad after huge losses in tradings. Okay, we'll tackle that one as we get into losses. How much money needed is in an account to qualify for trading option spreads? TD won't disclose it. Usually, I can't use any option strategies because my low net worth. The basic strategies provided are inadequate to ensure low risk. Typically, if you want to get into options and you want to trade options and you understand options, again, I don't recommend you get into options until you understand what you're doing, because options is like trading dead fish. If you don't know what you're doing, the more they start to stink, the more you hang around them. So if you really want to get approved for options, usually I think you need a 20, depending on the rules were different when I first opened accounts, but I think it's $2,500 to open up a margin account, because you need a margin account. That's first and foremost, because trading options is margin based. And then the other thing is you want to make sure you're marking that you're doing a lot of speculative trades. They usually, if you're looking for growth, if you're looking for capital preservation, if you mark those things on the sheet, they're not going to let you trade options, especially if your experience level doesn't match. So they basically look through the sheets and they see if your experience level, your capital requirements, your net worth just kind of fits the criteria. And if you're a person who, let's say, makes $20,000 a year, running your own business, and and you're looking to trade options, but you only have $1,000 in your account, well, you don't fulfill the requirements, and you're looking for capital preservation because options are usually more speculative. Number two, you need a margin account, so you need $2,500. So all these things kind of work against you. So you got to have a speculative account, pretty much high risk levels. That's what you want to mark on your sheet for approval. That's at least what they're normally looking for. And that's when they open your account much more so, because you're saying already, hey, I want to take on risk. In simple terms, the form you need to sign for them, what form you have to sign is the important line that says, I'm willing to lose all my money and you're not responsible for it. So basically, they don't want to be liable for it. And that's just the nature of their business, the legality side. So that's what you want to do as far as the form goes. Are you bearish or bullish on this market, and what will be the thing in your opinion that will cause the market to pull back? The thing is when you look at a market and you look at the overall thing, it's usually never one single thing that makes a market pull back. A lot of new traders, beginners, and just humans in general, we want a cause and effect relationship, which is usually a one-to-one relationship. So if you look at your personal relationships, dating, friendships, usually you want a one-to-one reason. Why did this girl break up with me? Why did that guy break up with me? What was the reason? It's, you're looking for that one specific reason. Why am I feeling sick today? Why am I unhappy today? It's usually not one reason. There's usually a snowball effect. So the market is kind of an organism, right? And the news tries to suck you in to make you think it's a one-to-one relationship and a linear relationship, but it's not one thing. It's not about the auto loan problem or the student loan problem that's going to cause the market to roll over. It's usually a multiple things. Just like with the housing thing that happened in 2009, it really wasn't just that one thing. It was just people over leveraged, and that was just the one thing that went first. That was the one thing that came to the forefront of people. There could have been a lot of other problems, their personal credit card problems, just emotional problems that created the fear mentality that caused the cycle in the euphoria, right? So think of it like a rubber band. The more things stretch one way, the more they're going to go back the other way. And that's the same thing with this market. With any market, really, the more it stretches one way, the more it's going to go back the other way. So I can't really say it's any one thing that's going to cause the market to pull back. It's usually a snowball effect. That's what you're looking for. One thing leads to another thing. It's like the butterfly effect. A butterfly flapping its wings. Can it cause a tornado? Can it cause a hurricane in the Atlantic and all these kinds of things? So that's actually what you're looking for, is how does the price behavior start making an impact to accelerate price movement in the other direction. And that's ultimately the thing that you're watching. So if we look at the S&P 500 chart right here, could this last month's pullback, this one bar, could that have been the trigger starting point? Absolutely. If we had this, you'll notice we had one extra pop. If we had a rejection right here and then the next thing rejection, that could have started a major problem. Because news starts to get more gossipy, news starts to get more negative, and that's how markets start to roll over, and that's how really bear markets get going. It's not usually just one thing, and same thing with pullbacks and so forth. So it's not just one thing. As far as for me, am I bullish or bearish? Longer term, what is longer term? I would say maybe after the summer, up until the end of the summer, September, October, I'm still bullish on the market, but not a strong bull. Say probably more neutral. I still think this market wants to go higher. It keeps pushing higher. That VIX is low, but it can have nasty 1 or 2 day pullbacks simply because this market is so stretched. When you start looking at the weekly and you start looking how far stretched we are overall from the moving average, it doesn't take a rocket scientist to see that. If you really need to see those things, take a look at the Bollinger Bands. Here's kind of on the daily. They keep stretching. And the more bullish this gets, the more bearish I get. And that is simply because, the professionals, they do opposite of what the market does. So when you get these massive runs like this, in the marketplace, that's when I start putting on short positions over in these levels, even in these levels. Sometimes it's even earlier where you see a couple of red days and you start seeing it, and that might be too early, but that's what you do because you get those nasty 1 days right here where when you get those 1 day movements to the downside, let's just go back to this chart. This 1 day, on 5/17/2017, we took out, if you draw that line across, we took out about, how many days is that? 27 days, almost a full month worth of gains. 1 day, right? So that's why you want to take profits into strength, and that's what we're going to talk about here today as well. So that's kind of my thought on the market. What is a circuit breaker? It seems to be a glitch in the matrix, which might have to do with scalping or taking advantage of a spread. I think what you're referring to when it comes to a circuit breaker is just if things plummet really badly, they have breakers that kick in to stop trading. I'm not sure if that's what you're referring to. It rarely has happened in our markets. It does happen in other markets more frequently just because of the liquidity aspect. So here, I haven't seen it happen too often, but that's what they're talking about, I believe, if that's what you're asking about. Okay, I have about $80,000 in Regeneron. It's gone up over 30%. Should I continue to keep it? We're going to talk about that in talking about profits here today, actually. So you'll be able to make your own decision on that one. Can you explain simply what functions come with a charting service and the difference in a free or paid charting platforms? Yeah, absolutely. Charting platforms, there's so many different charting platforms. I use TC2000 here, and this is a paid version. This is not the live real-time version. In fact, if you go to the website right here, there's a discount, I think, on the resources. I am an affiliate on there, but you do get a discount for the TC2000. I think it's $20 or $25? $25 from the Traders Fly website. So if you go there, this is the charting platform I like to use because it's fast, right? So I can click around and scan the charts really quickly. I can just type a keyboard shortcut, like let's say if I want Google, just hit enter. There's Google, it pops up. If I want Amazon, it's quick, right? So with the free service, they actually have free stockcharts.com for this, and you can use this for free. There's more of a lag time, more of a delay. There's more ads. You can't save certain things. You know, here I also have little panels like a 3 time frame view that I start saving. So if I want to look at Amazon, here's my 1 month Amazon chart, here's my daily, and here's 130 minutes, which kind of breaks things down. You could do like 65 minutes as well. So it allows me to look at the long-term, mid-term, and short-term really quickly. You know, so with paid platforms, usually you can just do more, save more. It's a little bit quicker. So is it worth it? It's up to you depending on how active of a trader you are. If you want a good platform, I find TC2000 is pretty good. There's a few others that I've mentioned in the newsletter list, and I probably should add those on the resources page. But you're basically looking for simplicity, something you're comfortable with. Most people, I don't think you need real time because you can get real time from your broker. So for example, when you're looking at the broker, you can get charts here, but I find that it's not as quick. So if I start typing in Amazon, yeah, I can see it, but then to draw something, I have to click drawing. I have to go to drawing tools. I have to click the line, and you know, now I start drawing something, right? And it's not as fast. And now if I want to do the other tool, I have to go back to tools. I have to go to drawing tools. I think they have some shortcuts, and you see I tried to click it, but it went there. So I have to click the actual bar and then go there. Whereas, you know, right here, I could just basically hit the control key, hold it, and just start drawing. And you can see it actually puts it in the other chart as well. So if I start drawing like horizontal lines, that's what they do. So anyways, that's kind of what I look for in a charting platform. It's just quickness. Would like to know more about level 2 and time and sales charts. Level 2, I normally recommend for people to stay away from it. It's usually a gimmick, I find, for the majority of traders that get bought into it from day trading or day traders who try to pump it too much. And the reason I say it's kind of a gimmick is it's a little salesy to say, hey, you know, you got to learn level 2 so you can buy my program. And the fact is, I think there's a lot of great traders out there that don't even use level 2. Level 2 used to be really good a lot earlier in the years. Nowadays, what happens is because so many people watch that level 2, a lot of the hedge funds and money managers actually play tricks on you to the point where they put in these orders. They call it spiking, right? So they'll spike it up or spike it down and bring it back up because they're just testing to see the buyers where they're at, or the sellers where they're at, to see, you know, the day traders, to see the retail traders or the dumb money, where are they getting in and out of those positions, or if they're antsy because they trade more emotional, right? So if you're new, you're trading more emotional. And that's actually what happens is they'll spike it and they'll see where you're at, where you're positioned. And that then they play tricks on you. So they'll spike it so that they see where you're at. They put in these orders, and they put this curtain in front of you. So that way you think that, oh, they're doing a big trade. And then shortly after, they'll make changes on it real quickly. So I would say stay away from that unless you're really looking to day trade. And the only point really to use level 2 in time and sales is more so for really day trading or very active trading. If you really want to know the inside scoop of what's happening in the marketplace, you want to get a Bloomberg terminal. Bloomberg terminal, I think it's around $25,000 per month, but you really get to see the ins and outs of everybody's trades and what's happening. So anyways, if you want to go that route, you can go that route, but obviously you need to compensate for that. Do you really need that? Not really. For most people, no. Okay. All right. So that's kind of all the questions right there. Let's see if we have any other things. Is it questions that came in? Okay. Is it a good procedure to use the daily list to day trade? A lot of people ask about day trading. Day trading it's really bad in these conditions. And I'll tell you, because the market VIX is low. When you look at the VIX, right, and we look at the CBOE volatility index here, when the VIX is low, day traders and people screaming that they want this thing to the moon, it's not really adequate or not a good time to day trade. You want to day trade when this thing is around 12 to 16 or higher. And the reason for that is because volatility movement in the market is the core breath or the lifeline of a trader, right? So if you don't have movement, like you're getting these $1 or $2 or on the S&P or $4 or 5-point move on the S&P, it's nothing, that's nothing. The movement is so minuscule, you barely have room to make money on the spread, right? So it's really not even worth it to day trade. As far as the daily list. So if you're looking at it, when you have conditions between, let's say, 12 and 16, you could almost day trade any stock. You could almost day trade just about any stock. I'm not saying you could with every single stock, but any big stock in that top 10% range that's popular, that's active, that's liquid, you don't even have to think. You just choose a direction. You have to be flexible with day trading, whether you're short or long. You have to be really flexible with it. But you want that VIX higher. Now, you get these people in the chat rooms. What happens is, you're over here and you get these people with whatever their income levels are, I don't know, but they start pumping here. Oh, crush the VIX. You got to crush the VIX because they want prices to go higher. And with the market here that we have that continues to pump and go higher, that's what happens. But unfortunately, you actually make less money. So the professionals, they actually want the markets to sell off. Believe it or not, professional traders, we're more bearish most of the time. We want markets to sell off because when you have a market selling off, you have more volatility. More volatility creates opportunity. More volatility creates option spread prices that are premium that's higher. It allows you to make more money, right? So anyways, but as far as, daily list, yeah, you could create one on moving percentages or percentage basis, which ones are most active, more volume surges. You could create your own list. When do you use a moving average and MACD indicator? I rarely use the MACD. I very seldomly kind of look at moving averages. They're on my screen, but I don't really check them that frequently unless we get a turn. So meaning they're on here, but I don't use them as a trading signal, right? So here we got a bounce off of kind of the moving average, and here we had a turning point beyond the moving average. So if you look at Amazon right here, I could also say that that's a trend line. It broke out above that. So again, if you get a rollover effect, like you could say, okay, here is under the moving average. Again, you could use it in that way. Now, which one you use is up to you. You could use the moving averages and base your whole trading system around that. That, again, is up to you. For me personally, I don't use it. I use it in combination of just verifying my position, verifying my understanding of the stock and the movement that it's had. And it somewhat helps you see kind of the patterns, right? So you could kind of see that in the moving average here, there's kind of your ABCD pattern, right, as well. But other than that, I don't really, MACD I rarely use. I probably look at MACD once every month on a certain stock. If I'm checking something, seeing certain conditions, same thing with RSI, same thing with ADX kind of thing. I don't check those things because they're lagging. They're lagging indicators, and that's why I don't use them. There's a reason, right? For me, price and volume, this is how I have most of my charts. Actually, in fact, the way I normally have my charts is actually just slightly different than this. I'm going to show you the way I do it. It's actually, I use the bars. And I create and do the candles simply because they're easier to film with. But for me, I actually use the bars like this because it's more compact. But for filming purposes, I actually use the candlesticks, since they're thicker and easier to see on screen. So I do things a little bit differently on video, just so you can see it. But other than that, the moving averages, same with the S&P, you can look at it and say, okay, well, we bounced here, we broke under it, we tried to test it, we broke back above it, we broke under it. So you could say, well, that could be a start of something. But again, it's just a guide. Okay. What sectors do you feel will have a strong second half of 2017? I have no idea. Honestly don't know, because I don't look at just second half of 2017. I look at the movement, and that can change week to week. I'm not looking at any specific, one sector here or one sector there. I'm looking actually the specific stock itself, which stock is moving and also which indices are moving. And lately, I've actually been trading more just a couple of indices, simply with the drama that we have with politically here, with all the different politics and so forth. So I've been trading more the indices, like the IWM, you got the TLT, you got the GLD. So those things are pretty good, and they're very diversified. But in general, if you're looking at sectors, you look at the ones that are moving, and then once they stop moving, okay, because these are the leaders. Go to a grocery store. You typically buy the same foods. Or if you go to a grocery store, remember the 80-20 principles, or take the top 10% of that food, right? You'll probably stick to the healthy food area, the pineapples or the fruits, the veggies, the lettuce, the tomatoes, the spinach, all the healthier stuff. You probably want to stay away from the junk food. And that's what you actually want to do. And here, when you look at this, and you start looking at these stocks, even though these stocks ran up quite a bit, these are the ones that are the healthiest. These are the ones that are the strongest. That's what you want. You want the fastest moving stocks in the shortest amount of time. Now, you also prepare for these to start rolling over eventually, right? So if you look at ABCD patterns and a projected move, for those of you that have the green course, here we have 373 points on the movement. And here, when I look at it, 373 on this movement, give or take, would put us around 1,084. Call it $1,100. So it's got about 70 more points to run, technically speaking, but it could roll over sooner, of course. That's why you want to take profits into strength. What kind of news do you follow on a daily basis to evaluate other traders' reactions? I don't follow the news. I skim the headlines, but I don't follow any news, actually, to tell you the truth. I have a TV, but I don't watch it. I don't turn it on. So might be ironic, right? So I basically skim the headlines. So I look at just a couple of quick headlines. Actually, mostly they could be on my phone in the morning, and I look at the pre-market. And then what I do is I just look at this, right? So I'm going to show you right here. Let me pull up a screen. If you search for Dow Jones futures, DJ futures, and you just hit, you look at this right there, and then you go to the world markets right there, and you just take a look. See how the world markets behave. You take a look right here. Here's the commodities, right? So world markets is actually more so important, and you want to look at the world markets to get an idea. This will give you some insight, because if there's actually panic, let's say in Japan, that can carry over. If things are stable, things may be okay. Because what happens is when you're a really big trader, you have a large account, what they actually do is, believe it or not, they're trading right now. They're trading at 2 a.m., 3 a.m. when the FTSE opens, because they will hedge that position ahead of time before our markets open. They're trading on a global scale, right? That's the big boys, the institutions and things like that. So they may do some hedges around these world markets, and that's kind of gives you some insight on the reading. So keep in mind that big picture. You can do the same thing with Bloomberg. It doesn't really matter which website you're looking at. You can do Bloomberg and look at a couple of news pieces, and I'm just looking at headlines, right? I'm not looking at what happened to Apple stock. And what are they releasing, right? So all these conference calls, things that they do, let's say on the news, that they say, hey, here's the new Apple seminar or headquarters showcase and product display. And they'll tell you, this is what's going on. They're releasing the Apple 8. Great. Fantastic. Do I care? Not really. What I look at is, if I'm looking at Apple, I'll look at Apple and I'll say, okay, well, they released it. They're talking. How is it moving today? Okay, so let me look. Okay, well, let's say this is when they started chatting. Okay, it's going off and moving sideways. Okay, nothing happened, right? Then that news thing is done. That's it. Within moments, that news thing is done. And a lot of times, most people know ahead of time what's actually going to happen. You think they don't, but they do. They know. They already expect and project those things. So that's why you're just watching market behavior. You're not really caring about the news. You care in the sense of big moments coming up. So what I like to look at is the Fed, the jobs report. Those are usually market movers. And what I do is I be a little more cautious depending on my position and setup. I'm a little more cautious going into those events. So if the market has had a major move, let's say to the upside, and we're going into in 2 days a Fed announcement, then what I'll do is I'll just sit on my hands or go a little more short because the market's already stretched to the upside. And the same thing the other way. So if we're sold off in a big way and we're going into another announcement, then people will say, it's not as bad, so they'll buy it up, right? So it usually goes kind of opposite like that. So you look at the spring effect. Can you explain roughly what are the Etfs? I'm not sure I understand that question. When is the best time to trade the VIX? Typically, I don't trade the VIX. The reason I don't trade the VIX is it's a fear indicator. There's no reason to trade emotions or fear. It's an interesting way to hedge. I mean, you can do it if you want. But normally, if I was to trade the VIX, which I don't, but if I was to do it, and I used to in the past, I would go out something like 40, 60 days on the option side. And you can see there's no real put side. And again, this is the problem. With a low VIX, you have no put side on the VIX, which means you can't really trade too much. There's no premium baked in. So what do you do? Well, you could create a vertical. You have to basically go on the call side, right? Which, number one, if you're an option trader and you know options, you know that doing things on the call side stinks more so because on the put side, you have more premium, and on the put side, you can get wider and so on and so forth. So anyways, you're already at a disadvantage right there. Number two, since the VIX, you need it to really move, because a low environment can mean a 10, a higher environment can mean a 12, depending on the market conditions. It depends on the current market condition. So what you're doing is you're actually, if you're trading the VIX, you're almost hoping that you get a movement, which often is a spike, because the VIX right now is low, but you get a movement to the other direction. Now, if the VIX was like at 30, then you'd probably do something a little bit different because you're selling premium. But here, I mean, if you go 60, call it 132 days out, what you're doing is 11 to 15 is kind of the range. So you can buy let's just put one on real quick. You can see it, a vertical. You'll notice the premium is not a lot, but what you do is you're basically buying, a vertical spread right here going 11 to 12 or even 14, because you're looking for a VIX to spike sometime in the next 130 days. And when it spikes right there, you're making 46 bucks, maybe 124 at most, 125. Not a lot of money when you talk about market conditions. So you have to almost bump this up, let's say 5 contracts. So what you can do is now when you get that spike to 14, you make 240 bucks, maybe 625, right? Whereas you can do the same kind of hedging or playing fear on a TLT, which is the bonds, or you could do the SPX or IWM and kind of short it or sell the calls, and you get a lot more wiggle room and more premium, and you trade less contracts. So anyways, I don't usually like to play the VIX, but there are people that do it and they make good money. But for me, I don't trade fear because it's a fear indicator, right? So that's really what you look at. Do you ever have trouble getting your order filled? In which situations might this happen? Order filling trouble happens usually with low liquidity stocks that don't have a lot of volume. When you don't have a lot of volume, it's tough to get filled. For me, I usually don't have trouble because I trade the big stocks. I trade like we talked about, the top 5-10% of the big boys, right? You probably know them. The Netflix, Amazon, Apple, those are the ones I prefer to hang around with, or even the ETFs. Why do a lot of traders trade the ETFs or hedge funds? Look at this. You look at the liquidity. The liquidity and the bid-ask spread is huge, right? 32,000 contracts here, 21,000 contracts. If you look at the SPY, which is usually people who have a little less capital, you look at it, 70,000 contracts, 50,000, 63,000 contracts. So the open interest is huge and the volume is phenomenal, right? So it's easy to get in, bid-ask spread, very tight. So I usually don't have trouble getting filled, but some people do, and that is if you're trading low liquidity stocks, which I'll give you one or two here. Kind of caught my eye this evening right before. Here is one, HQY, and you can see it's 342 on the open interest and 156 right there, and this one as well, you can see in zero over here in this area. So about 300, compare that to the SPY. And the reason I had that one on my list is I was just kind of looking at it as a stock that was somewhat starting to break out. That's the weekly for you, by the way, if you want to look at it. And you can see there's the spike. And here's another one, PTCT. Also, you can see this one had a lot of problems in the past. So if you're looking to nibble on a cheaper stock, you can see it's coming right into that price level to watch. Anyway, so hope that gets you answers the questions. Roughly explain DWT and UWT are opposite charts. If one goes up, the other one goes in. Exactly. DWT. Are you talking about the 3 times ETF? 3 times ETFs. I've talked about this in the past, but I try not to talk about it too much. And too many beginners get into these 3 times ETFs in the wrong way. You trade them incorrectly. 3 times ETFs are usually used as a hedge to leverage on a day trading basis. You do this based on a TZA, so you can look, this is a 3 times ETF bear, and they're actually releasing 4 times ETFs. And here's the question that they've been debating: where is it going to stop? 5 times, 6 times, 10 times, 20 times ETFs. You're leveraging in a big way. There's the SDS, Pro Short, Ultra Short. You have FAZ, 3 times bear financial ETF. So when you're talking about UWT, 3 times crude, and these things compound and reset, all I'm going to say is stay away from this unless you really know what you're doing. In simple terms, they recalibrate on a day-to-day basis. These are day trading vehicles to where if you have, let's say, a $5 million account, right? And $5 million related to, this is crude, right? So you have a $5 million account and you're positioned one way, right? You're positioned, this one is the long crude, right? So let's say you're short $5 million and you believe that it's going to go against you, or there's a problem that's going to happen that it's going to affect your positions in a negative way. So what you do is you get these ETFs for 1 day, 2 days, maybe 3 days max. But at the end of each day, they recalibrate it, kind of reset it, kind of re-average it. And notice why these things continue to always head lower. They compound because they recalibrate. So if you look at SDS, look at what happens here. I mean, just you don't have to be a genius to look at the chart. Here's FAZ. I can't even look at this. This was at 160,000. Come on. Don't trade these when you're new. Stay away from this kind of stuff until you know what you're doing, or you have a coaching session with me or something to that effect, because these can really burn you. And I've seen a lot of people's accounts. There's also the VIX 3 times ETF. There's a lot of them. Anyways, they just suck you in. Usually people get sucked in with the get rich quick mindset. All right. So that answers, I hope, most of these questions. I think we went through a lot of questions. We're already up 45 minutes on air. What I want to do is go through profit taking, and we'll go through and talk about profits here. I have some notes. It's too bad the camera's not working on the other side. So what I want to do, why don't I just hold them up? Why don't I do that? That'll work. I hope you guys will be okay with that. Do things a little bit different. It is live. So I started doing a couple things here, but might just hold them up, and I hope you'll be okay with that. So I made some sheets here, so that way we can go through the lesson. So looking at profit taking, and we'll get kind of into the losses here as we go through, and the goal of stock trading, the goal of a business in general. You know, what is the goal when you look at it, when you start looking at this? What's the goal of a food business? Let me see here, make sure the focus is correct. Okay, so what's the goal of a food business? So if you look at a food business, is this the right way? Are you able to read it correctly? Not sure if it's mirror image. Might be mirror image. Let me see if I can flip it here. X. Oop, wrong way. There we go. All right. Now we're cooking. All right. So food business, when we look at it and we start simplifying the food business, right? So what's your goal? The basic goal is you take a person, you want them to come to your table, you serve them the food, right? In this case, pizza, and you get your money. So that's the basic way that a food business works, right? And in a simple context way, that's the way it works. Of course, there's marketing that goes along with it, but that's your goal. Take the person, serve them the food, you get your money. That's how money is made, right? In the stock market, okay, so when we look at the stock market, how does it really work? Well, you have your capital right here. So you take your money, you have your capital. That capital, you go ahead, you buy stock, you invest in stock, you sell stock, you go long, you go short, take that stock, and then eventually you take your profits and you get more money back, right? Hopefully that's the end result, and hopefully that's what happens. But simple concept, you have money, you have capital, that's your workers, you get stock, and then you want more money back. So your goal is to take profits. And here, in this case, periodic profit taking creates consistency and it reduces your risk. So that's ultimately what you want to do, is you're constantly taking profits, right? Because that's the goal. That's the simplified version. The most simple version is you have money, you get stock, you sell stock, or you buy stock and you sell it for higher prices, or you short the stock at higher prices and you buy it back at lower prices, and then you get more money. So you want periodic profit taking. That'll create consistency. If you do this consistently, it helps also to reduce your risk. And that's the business. That's how the business works, right? So you want to make sure that you take profits often. And taking profits is more important than the when. You know, a lot of people focus on, hey, when do I take profits? When do I get out of the stock? And yes, of course, there's technical analysis you could do. You look at the overall market conditions and so forth. And this does play an important role to maximizing that. But most traders, from what I see, is they don't even take profits. They don't even take profits. What they do is they get into a stock and then they get out of it all right away. They don't really take profits. Some people, the worst thing that happens is actually they take, what they do is they get into a stock and then they sit in that stock and they sit in it for a year or 2 years or 5 years or 10 years. Time goes by, that stock sells off. They say, oh, I plan to sit on that for years, you know, for a long time. And they get dividends, and that's fine. You know, in that case, that might be okay to some degree, depending on how active you want to be. But they don't even take profits. They don't take profits out of the market so that they can use it to live a better life, or that they don't take profits so that they can reinvest that money, because the point is to compound that money, especially if you want to be more active, right? If you really just want to invest in some stocks, I would say just pick a couple ETFs that give you dividends, put your money there and let them sit, and when you have large pullbacks, go ahead and buy a little more. And that's ultimately the simplest investing strategy. But if you want to be a little more active, compound, and make a little more money on a consistent basis, then you have to be taking profits in the strength. So the thing is the when to take your profits depends on your risk and money management system or style. It doesn't depend on when I recommend it. It depends on you, because everybody's at a different risk level. Everybody's at a different risk tolerance. Everybody has a different amount of capital. So you might be in a different size position. So you might be positioned differently. So taking your profits is more important than not taking profits. And it depends on your risk and money management style. It's not depending on mine or somebody else's. And that's what most people do, is they try to get into looking at another person's system. And when they look at another person's system, they say, hey, well, if they're doing this, I should be doing that. Well, it's if your friend jumps off the bridge, will you too? It's a classy thing, but a classic saying here. But when it comes to financial decisions, we start getting sucked into these things. Psychologically, mentally, emotionally, we think we don't know better. And it's for you to discover what works for you. So take, for example, buying a sports car. I know that a lot of people in the trading community, they showcase the sports car. Hey, you can have this sports car. That's what most people want, because they want the attention. The reality is, for most people, that's not necessarily what they want. Most people want a family. They should be looking to buy a van or something to that effect, where you can hold more people. Yeah, it's not maybe as fashionable, it's not maybe as fancy, but it's more practical, right? So anyways, you look at what works for you. Don't look at somebody else and try to exactly adapt that system for you. You can use ideas, you can use concepts to make you think about things, to make you get ideas to adjust your system. And you can take variations and concepts, right? So if you're creating a painting and you're drawing something, and I remember when there's different decades of paintings and how paintings and art has progressed over the years, right? So in the past, there was just flat 2D kind of drawing and painting. And then eventually we got into 3D type of art, right? So we went into 3D versions and shadows and things like that. So once that happened, then yeah, you can take concepts. Hey, this person drew in 3D. So I'm going to take that 3D concept perspective and start applying it, but I'm not going to draw the exact same thing. I'm going to draw something different. That's the same thing for you. You could take the concept and idea and apply it just slightly different to make it your own. So that's kind of what you want to do. So the dumb way that takes money and profits, which I kind of touched base on, the dumb way is usually what people do is they go all in right away, and then they go all out right away. And that's just the normal way that most traders do it as far as when they first get started. It's not the smart way, right? When you look at the smart money way to take profits, the way that they do this, okay, is usually they take it off in a couple different ways. So let me see here. What you can do is you can take profits, and let's go actually on screen here. So what you can do is, if we go here, see if we can pull up basic panel here, platform. So normally for the smart money, what they do is, they'll take, even if you're new, right? If you're new, you'll probably go all in and then you go all out. That's typically what most people do. This is the dumb money, right? Or if you want to spell it differently, there's the dumb money. If you want to look at the smart money, the way they do it is they'll probably stack it in like half and half, or it could be in a quarter and a quarter, or it could be a quarter and a half, right? So you're getting into a position, and then when you get out of it, what you do is, again, the same concept. You get out a quarter. You might get out a quarter right there, and then the remaining half. So you could stack it like this. It's all about scaling, right? You're not going to get in 5,000 shares of Tesla in one single day. It's not the way traders trade on a professional level, or 50,000 or 100,000. They stack it, right? And that is for a couple of reasons. Number one, because they don't want their position to be seen, because it's a little bit more market moving when you do that. But number two, it's a risk management concept, right? So when you look at this, you reduce your risk by, let's say you had one down day. Okay, if you're going in and you buy, let's say 100 shares, another 100 shares, another 100 shares. Okay, so let's say you did it in thirds. Okay, this day was down, this day was up, and this day was up. So when you look at it, if you started to average these things, you know, and the stock continues to head higher, at least you had one down day that you were able to purchase the stock. And the next ones, maybe you didn't have a pullback to get into the shares, but at least you had, you know, you started to kind of reduce that risk. And that's the way you do it. And the same thing, as the stock continues to move higher, in your favor. So, okay, you say, okay, well, I'll take 100 of those shares off. And that was the first shares, right? The first shares. So you took 100 shares profits. Stock continues to go higher. You might say, well, I'm going to slow things down because I still want to keep my shares. I'll take 75 shares in profits. Then again, you do another 75 shares in profits to where finally you do the remaining amount at the end, once you see things roll over, or you decide to, or you're going on vacation, whatever the reason is. But that's how you do it. That's how you stack the positions, because you're reducing your risk over time, right? You're spreading your base. And the dumb money, the way they look at it is saying, well, I could have made more if I held on to the stock. Well, yeah, you could have, but you're not managing your risk. This business is about managing your risk and managing your money. Right? Well, if I spent $5,000 more, I could have bought a better car. Well, yeah, but do you really need that extra feature, or do you need that extra little widget or device for that $5,000? I don't know. For some people, it's fine. It's not a big deal. For other people, you look at money management, right? Is a pair of socks worth $50,000? You know, for most people, no, it's not. But if you're in freezing weather and it's kind of you know, you're getting frostbitten and you're in the middle of the Antarctica where it's really cold, might be worth it, right? So it just depends, right? And depends on your personal situation. So for a lot of people, they give excuses in this situation. They say, well, it's going to cost me $5 for every trade. Yeah, it costs you $15, $5, $5, $5, $15 in commissions. Big deal. You're risking probably $1,000, $2,000, $5,000 if you're new. That's if you're new. As you start trading larger, you know, you start trading 500 shares, you might be risking, depending on the stock, it could be $50,000, $100,000 in a blink of an eye. That's what you have on the table. And you're worried about $15. You know, think about that. So, you know, don't get attached to the micro things in business. So look at the profit potential. You want to take profits off into strength. Sorry, here, let's move this up. Okay, so we get back into it here. So what's your goal? What's your goal at the end of each month or at the end of each week? Well, your goal is to be profitable at the end of each month or at the end of each week, right? Depending on how you trade. For day traders, it's going to be profitable at the end of the day. Now, normally, even if you're day trading, as a day trading tip for many people, I would say look at a weekly thing, right? So if you're day trading, look at a weekly thing. If you're a swing trader, look more at the monthly concept, or even a 2 or 3 month quarterly kind of concept of if you're profitable in those times, because you'll have probably, as a day trader, you'll have probably a bad day or two. And as a swing trader, you might have a bad week. So that's why you look at kind of the monthly. And that's what you want to do. Is your goal is to make sure at the end of each month, or at the end of each quarter, or at the end of each year, that you're profitable. Just like when you look at a business, right? When you look at a business and on that business, people are coming in, you want to make sure you're profitable. So on a business balance sheet, as you start looking at these things, we're looking at the income and the expenses, right? So you might have people coming in right here, and people are coming in and people are buying, let's just say, food, and this is your income. So they get the appetizers, and that's, again, you're making money, right? You're making money on the food, the appetizers. They could be buying gift certificates, right? Bear with me since I don't have my full table and camera. Gift certificates, that's your income, right? On your expenses side, right here, you might have to buy a printer. You have your staff that you have to pay for, okay? You have to buy sometimes new tables or cooking equipment, okay? So these are all expenses. That's just kind of the way a regular business works, the way a regular business runs. You're looking at income and expenses. Pretty simple, right? Let's keep it simple. Let's not make it too complicated. When you look at, trading, same thing, right? So you'll have some trades that'll be profitable. So let's say if we break this down on income and expenses, so let's say you have a trade that's profitable $200, $300, $400, right? So you're kind of starting at that rate. And then you have expenses. At the expense level, again, you'll have losses. It's really simple. You don't have to go through printers and buying inkjet cartridges or anything. But again, you might lose $100, $400. You might lose $200. So again, basic simple math to figure out what's your profit, what's your loss, where are you at, how are you doing, and what are you doing at the end of the month, right? Doesn't matter when you take your profits. It just means you get to add more numbers on this column. That's your goal. That's it. That's your goal. You want to keep adding more numbers to the income side. Of course, you want the numbers larger, right? We want the numbers to be larger, but many people don't get this concept. For me, when I look at it, even if you're taking a $200 profit right away, hey, that's a $200 customer, right? Right away, that's a $200 customer that's right there in your store or on your restaurant that just spent $200. And that's the way you can use your dollars, the way that you look at your dollar bills using capital in your trading business. $200 is what the person spent. So you made $200, $300, $400, whatever. You're trying to make this higher and higher, right? For many people just getting started, just at least start adding numbers to the income side. You're going to have some expenses, just like a printer, just like inkjet cartridges, new cooking equipment, wait staff and parking fees and rent and all kinds of things. So you'll have expenses still, but what you want to focus on is just constantly taking money off the table. And most people, they don't even do this. They don't take the income side and look at it and start adding money onto their table. What they do is they try to go in and get that rock star customer or rock star client. And they try to say, hey, here's my $5,000 customer. He's going to make me all the money that I need to run my business. But for how long? 1 month, 2 months? Business is all about consistency, right? If you run a food business, food restaurant business, you want consistency. You want people to keep coming back. You run a dentistry, same thing. You want people to come back for cleanings. You want chiropractic care, same thing. People coming back. You want computer repair, same thing. People coming back. That's what you want. And the same thing in trading. What do you want? You want to continue to be profitable, even if it's $5, even if it's $10, $20, it doesn't matter what it is. Even if you're breaking even, you want something. Think of breaking even as giving a free meal to somebody if they're homeless, right? You could think of it that way. It could be towards your trading education, right? You just using it as your trading education. Could be a free meal to somebody that complained, right? Business flat, right? So you gave them a free meal, but maybe they'll come back. So it's kind of one of those things where whatever works in your mind to position it that way, to where you build up your income side and try to reduce that expense side, that's really all it comes down to. And you got to take profits. And most people don't. Most people, they want to go all in. They want to make, hold on to that trade and try and hit the tops. They try and hit the bottoms. And that's probably the biggest mistake, because you're trying to milk a cow that has very little milk in it remaining, right? That's what you're trying to do. You're trying to get the most out of it, when instead, why don't you give that cow a break, a day or two, and then get a whole big bucket full, right? Makes more sense in that case, right? So that's what you want to do when you're looking at profits, taking profits, and the psychology behind taking profits. Not to mention, when you get into the emotional side of things, right, and you look at taking profits into strength, taking a quarter off, you feel good. You feel happy. When you feel happy, you feel more, how shall we say it, more goal-oriented, that you're doing the right thing. You have success, and that allows you to think clearly. Whereas when you're in an emotional state and you feel a little more fearful, oh, it's not moving my way, oh, I'm not doing the right things, could have done this better. Well, in that case, you're basically putting negative energy onto yourself. You're putting all this negative pressure where the things that you're doing is wrong, and eventually you get out at the wrong time. You're not thinking clearly. So taking profits helps you stay consistent. Okay, profits, $10, $50, $100, $200, $500. And you'll continue to grow that over time, because you learn to get into that habit of taking profits. Stop worrying about the tops. Stop worrying about buying at the bottoms. Look at taking profits off into strength. Should be your goal as a trader, and looking at the business side of trading, because that's how you do it. More money on the income side, less on the expenses. That's all it comes down to. Simple. Keep things simple. And that's what this business is all about. Don't make it more complicated than it is. So anyways, any last final questions here as we wrap things up? We've already been on here for quite a while, about an hour on the recording side, and more than an hour and 10 or 15 here on the other side. So let's just take a look and see. Otherwise, I'll kind of call it a day or evening. Thank you so much again for everybody for joining me. I truly appreciate it. It's really nice to have the following, the fellowship that I have here, and people asking the right questions and thinking and helping each other out. That's always a good sign. So if you're just new to trading, if you're just watching this for the first time, start slow, build things up. You don't build a business overnight. You don't start trading overnight. It takes time to get it down consistently. Yes, you can set up your account fairly quickly. Yes, you can, put on a trade fairly quickly. But to get the profitability, to get the consistency, it takes a lot of hard work. It takes a lot of time, energy, effort, studying. And I know what it takes to put in, because I started this in my early teenage years to start learning this. And it took me a long time to get it, to figure out my own things and strategies and systems and how to do things and adjust things and hedge the portfolio and putting things together. So I know what it takes. So if you're struggling, keep pushing yourself a little bit further. You'll get there if you put the time and energy in and really work at it, because you have to do the work and see yourself from that outer perspective. See what you're doing right, see what you're doing wrong. Anything else? All right. Well, thank you for joining me. Tons of people this evening. So thank you so much for all the questions. Those of you that posted questions, truly appreciate it. Hope you enjoy the rest of your trading week. Be careful here as we approach here some of the news events. I think the Federal Reserve is on the 15th or 16th, whatever the next week is there. So keep an eye out for those market moving events tomorrow as well. We may get a market moving event. I'm not sure what the futures are starting to look like right now. Let's just see. They're flat. So anyways, we'll see what happens here. It may be nothing. It may be something. Be nimble. Stay hedged on your trades and be prepared to move in any direction, right? Because it can whipsaw around, especially that first little bit that it'll whip around one way and then it'll snap back the other. And that's what they do. That's what they like to do to really get people in and out. So don't be too quick on the trigger there. Be patient, because things will move fairly quickly as the VIX pops. So anyways, thanks again. I hope you enjoy the rest of the week. Trade them well and enjoy the weekend. I'll see you next time.